Many view a bank as a high-security storage room. You hand over your cash, they guard it, and you withdraw it when needed. In reality, a bank functions as a machine that turns other people's money into income-producing assets. Just as a bakery takes flour to manufacture bread, a bank takes your deposits and processes them into loans, bonds, and investments that generate revenue every single day. This flowchart shows the specific mechanism at work. When you deposit $100 into a checking account, the bank keeps a small fraction in reserve, say $10, and immediately lends the other $90 to someone else. The person who borrowed that $90 spends it, and whoever receives that money deposits it into a second bank. That bank keeps $9 and lends out the remaining $81. This cycle repeats until your original $100 deposit has effectively created nearly $1,000 circulating through the economy. This cycle is the reason a modern economy can function without the central bank physically printing a new dollar bill every time someone needs a loan. It works because of a calculated assumption that for most of the time, most people will not ask for their money back simultaneously. If you wanted to run this machine yourself, you would first face a bureaucratic marathon. Before you accept a single deposit, expect to spend between 1 and 3 years simply filling out paperwork and seeking regulatory approval. You must obtain a charter from state or federal controllers and separately apply for deposit insurance from the FDIC. Regulators reject applicants who lack a coherent plan, as they only approve banks they believe have a high probability of surviving. This chart highlights the difference between deposits and capital. Deposits are money you owe customers, but capital is the money that belongs to you. To manage $100 million in loans, you must provide roughly $15 million of your own unborrowed cash to serve as a cushion against losses. Your capital begins draining immediately. You have to hire compliance officers, pay for cybersecurity software, and lease a building. You are even required to set aside loan loss provisions, cash held in advance to cover the portion of your loans that will inevitably fail to come back. Because a functioning bank carries these massive fixed costs, regardless of how it performs, you are losing money from the moment you open your doors. Survival depends on how quickly you can generate revenue through the spread. This scale shows your primary engine, the net interest margin. You borrow money cheaply from depositors and lend it expensively to borrowers. The difference between the rate you pay and the rate you charge is the spread that keeps the bank alive. On the $500 million loan portfolio, a 3% margin generates $15 million in annual income. Once you subtract the costs of payroll, technology, and insurance, you arrive at your actual profit. But the model involves more than just lending. Banks collect a toll on nearly every transaction they touch, from wire transfers and monthly account maintenance to the interchange fees triggered every time a customer swipes a debit card at a store. At the top of the industry, these streams scale into multi-billion-dollar businesses. Large institutions generate massive fees through wealth management and investment banking, advising corporations on mergers and helping them raise money in public markets. This position allows banks to capture a small percentage of almost every major economic flow. In 2024, this mechanism drove J.P. Morgan Chase to earn $58 billion, the highest annual profit in the history of American banking. Most businesses grow by using their own money to buy equipment and generate a return. A bank is unusual because it operates almost entirely on money it does not own. This is the power of leverage. You take a massive pool of customer deposits and balance them on a tiny sliver of your own equity capital. Leverage allows small percentages to become inconceivable sums. If you earn just a 1% return on $500 billion in assets, you have generated $5 billion. For the owners of the bank, that represents a massive 20% return on their actual equity. This extreme efficiency is why the wealthiest families in history often chose to own banks rather than factories. They understood that sitting in the middle of money flows allowed them to multiply their personal wealth at rates practically no other industry can sustain. This model generates extraordinary profitability when the economy is stable, but because the system relies on such high levels of leverage, that profitability comes with an inherent structural danger. Leverage amplifies losses. If asset values drop, it comes out of your tiny equity cushion. A bank with $50 billion in deposits and $5 billion in capital is insolvent after just a 10% loss. your capital is completely wiped out. This is the trap at the center of the business. The same mathematical formula that creates record-breaking profits is the exact thing that allows a major bank to collapse at an incredible speed when the market suddenly turns. Washington Mutual spent 17 years growing into the largest savings bank in the United States. Its collapse began with a structural dependency on rising home prices to make the math on its subprime mortgage portfolio work. When housing prices stopped rising, defaults began to pile up. The news of the Lehman Brothers bankruptcy in September 2008 then triggered a shockwave of fear that spread to every other institution in the system. Panicked depositors withdrew nearly $17 billion from Washington Mutual in just 10 days. Despite nearly 2 decades of growth, the bank ran out of the cash needed to conduct daily business and was seized by regulators. Silicon Valley Bank's death was even faster. Their failure was caused by interest rate risk, holding safe government bonds that lost value when the Federal Reserve raised rates. When they announced a loss on those bonds, fear moved through venture capital group chats at the speed of a text message. Customers attempted to withdraw $42 billion, nearly a quarter of the bank's total deposits, in a single day. A 40-year-old institution was gone in 44 hours because it had a negative cash balance of nearly $1 billion. Behind the glass and the vault doors, every bank is a machine built entirely on trust. It functions on the singular, fragile assumption that everyone will not ask for their money back at once. When that confidence evaporates, the math breaks, and the bank ceases to exist.